Well, some are calling it the Great Fall of China. And for more insight on the China stock market drop and its effect on the global market, we're joined by Henry To, Chief Investment Officer at CB Capital Advisors. Henry, good to see you. Thank you for joining us.
Good to see you too, Michelle.
Henry, the second largest stock market in the entire world is plummeting. The Shanghai Composite has plunged well over 20% since hitting a peak in June. Now that drop has wiped out nearly $3 trillion in market capitalization. To put that in perspective, that is more than the entire GDP of Brazil. Henry, how concerned are you about this?
I'm a little bit concerned. I'm actually not that concerned, Michelle, because when you break down Chinese household assets, especially financial assets, equities only make up 15% of Chinese households' net worth in financial assets. And there are a lot of first-time investors in this market right now, and as we all know, they're highly leveraged. So I think it's healthy for them to liquidate some stocks right now in order for the market to recover and also for the market to have some breathing room.
All right, you're finding this plunge healthy. Let's talk about some of the spillover effects, though. Is the China market drop hitting other global markets? We've seen a decline in commodities. Oil has been down. Copper has hit a 5-year low. Are these linked to the Chinese stock market drop?
No, I think these commodities you're talking about, copper, iron ore, oil, even natural gas in the United States and LNG all around the world, they've been dropping for a long time now, and it's not necessarily because of the drop in the stock market, at least not according to me and my studies. And the reason is because China is slowing down. As we all know, the economy is going to grow tremendously still, but the rate of growth is slowing down. We're projecting about 6.5% this year, maybe as low as 6% next year in terms of real economic growth. So there's a lot of overcapacity. China is not building as much as it used to. They're not investing as much as it used to. And so the rest of the world cannot absorb that capacity. At the same time, you have countries like Australia, even the US. The US, that's been a major supply issue in oil, as you know, and commodities as well, all the way to aluminum.
All right, Henry, let's bring it back to what we saw this weekend. Support measures were brought in to help the market. Government-backed fund is buying $19 billion worth of stock. IPOs have been shut down. Reports that short selling has been banned by certain funds. What other measures do you see Beijing implementing?
I think these are good first measures because right now, investors, especially first-time investors, they're not used to this kind of volatility and they're scared. They have a lot of life savings in the market. So if you tell them that we're going to provide you more with liquidity, that's not going to help them. They're not going to induce to be buying more equities. But now if you start saying, okay, we're going to provide 90 billion RMB of support funds to directly buy stocks. Now, keep in mind the Chinese market, Shanghai and Shenzhen combined, is still an $8.5 trillion market. So that 8.5 trillion US, and so the 90 billion RMB or about 20 billion in US dollars is not going to do much. I believe that more measures will need to be implemented going forward, including more rate cuts. Inflation in China is only 1.2%, and the 1-year lending rate is still only at 4.85. So I think there's a lot of room to cut rates. Also, China has a $3.5 trillion balance sheet. China Investment Corporation has a $750 billion fund.
Henry, other than the rate cuts, could these emergency support measures that Beijing has implemented specifically to help the markets work in the reverse? Can they be counterproductive in the sense that they may send a panic signal that things are so bad the government is forced to step in, and then that is interpreted then as a red flag? Do you think that could be a problem?
That could be a problem. I think there's a fine line in terms of intervention, so to speak. And when it comes to the stock market, I think there's a impetus for the Chinese policymakers to invest if valuations are low enough. So as a policymaker, I think they should look at valuations. I think they should look at only at the blue chip stocks. China Investment Corporation, they are already investing in Chinese financial corporations in the A-share market. They're investing in Chinese X-shares in the market. And that's not necessarily to keep the market supportive. They are actually doing this for the future of the country. So I think there's a lot of room for Chinese policymakers to invest as long as there's a valuation component, as long as it makes sense economically going forward.
Henry, overall, you're still bullish?
I am still bullish. I like H shares in general. I think H shares are still undervalued. When you look at the forward price to earnings ratio of Chinese H shares, they're trading at a 10.5 price to earnings ratio. One of the cheapest markets in the world, with the exception of South Korea, much cheaper than US stocks. Even Chinese H shares are trading at about 13.5 forward price to earnings ratio. But I would keep tracking, I would keep investing in the blue chip stocks.
Yeah, and those blue chip stocks have certainly been rising. Many of them, like PetroChina, up 27% over the last 5 days. Maybe it's a buying opportunity. All right, thank you so much, Henry To, Chief Investment Officer at CB Capital Advisors. All right, let's take a look at some of the other business headlines coming out of China.